Here's why a recession in the US would spell almost certain catastrophe. With the word recession on everyone's lips again, it's absolutely critical for everyone to understand the mechanics of what actually happens in a recession, and it's not pretty. Here's why a recession would spell almost certain doom for the US economy and serve as a margin call on the debt. So, first, we have to get the context of where we are starting from. Here's the fiscal deficit, which is just the difference between what the government collects in revenue via taxes and then what it spends. That difference, that gap, is called the deficit. And here in white, we're looking at that difference as a share of GDP. And then we're looking at the unemployment rate. These red shaded sections in all the next slides are going to show you official NBER recessions. And what we can see, unemployment spikes during a recession, and the deficit. The general idea is you run a larger deficit to stimulate your way out and kind of jumpstart the economy. And once unemployment starts to come back down again, the economy is starting to heat up again and come out of the recession. You bring your deficit back down. Well, that is not what has been happening since 2007. We are running an ever larger deficit. In fact, it is 7 times larger than it was in 2007, and that is despite the unemployment rate actually being lower. This is what is referred to as a pro-cyclical deficit, and it should be noted it is actually closer to 7% of GDP. This is slightly lagged data. 7% of GDP has only been reached twice before, 2020 and 2008, at least in the context of this chart, looking at it as a share of GDP. 2008 global economy was screeching to a halt, and 2020, the same thing was happening. So that is the deficit that we are currently running today. That is our starting point for the rest of the video. Here is government spending as a share of GDP, which has doubled over the past 70 years. Meanwhile, federal revenue as a share of GDP has gone straight sideways, bouncing between about 15 and 17%. That is despite government spending doubling. So remember, the deficit is the difference between what the government spends and what it collects. Well, what it's collecting is going nowhere. And spending has doubled as a share of the total US economy. It's also important to point out that during a recession, the two of the exact opposite things happen from what you would like to see. Number one, spending is going up. And as if that wasn't bad enough, revenue is falling. And it should be noted, revenue has been falling more and more as the economy has become more and more hyper financialized. The amount that revenue is falling is increasing, and that is due to, in part, the hyper financialization of the U.S. economy, which we have covered extensively in other videos. We won't do it here. Here is that federal tax revenue in logarithmic form, and here are some declines of various different recessions, which are again the shaded red areas. We could see 2008 revenue declined by 18.3%, 2001 by 11.3%, so on and so forth. Well, if you look at post 2000, again, this is really when the U.S. economy is most analogous to where it is today. We are in a totally different economic structure than we were in the 90s or 80s, certainly the 70s, 60s, 50s, and before. The U.S. has run ever larger current account deficits. The dollar has become more and more overvalued. Therefore, the U.S. economy has become more hyper-financialized. There are a number of critical things that started to change, arguably in the mid to late 80s, but certainly by the 90s. So it's important to look at some of these dynamics, some of this math, in terms of the way it would be today. And I think it's safe to say that we should look at the past 20 to 25 years for the most analogous comparison to how a recession would behave in today's day and age. So we're going to use 2020, 2008, and 2001, the dot-com bubble, for this math. So what we can see, revenue, again, is falling. The stock market is falling. People are unemployed. Therefore, there's no income tax being generated, right? Revenue is falling. In general, it falls by about 15%. Well, that would take our revenue for the government from 4.92 trillion, where it currently is, down to 4.2 trillion, and it would represent a $730 billion decrease in revenue. Here is that hyper-financialization and the degree to which the stock market really determines tax receipts. We can see that as basically the same line. I've done an entire video titled why a stock market crash will not be allowed to happen. Capital gains tax is a major driver of that total overall government revenue. This is becoming more and more pronounced as the economy becomes more and more financialized. Here's government spending. We established government spending as a share of the US economy has doubled over the past 70 years. And here is that spending in logarithmic form again, so we can see the real movement for each recession. Spending goes up during a recession. Spending kind of always goes up, but it goes up during a recession on average post 2000, 29% increase. Remember, this is the exact opposite of what you want to see. The deficit is the difference between spending and what you collect in revenue. Well, revenue is going down and your spending is going up by 29%. This would take our annual budget from 6.7 trillion up to 8.7 trillion in new spending. Again, assuming a garden variety recession hit today. That would result, we established the revenue has gone down to 4.2 trillion, right? On average, decreasing by about 15%. That takes our revenue from 4.9 to 4.2. And we just looked at spending, which has gone up. So they're going in the opposite direction of what you'd like to see. You are now talking about a $4.5 trillion deficit. Currently, it's about $2 trillion. So your deficit just doubled in, again, a garden variety recession. But wait, it gets even worse. So not only that, but your GDP, which is the balance sheet capacity to absorb new debt issuance. Remember, the way that we finance a $2 trillion deficit or a $4.5 trillion deficit is the same. We issue US Treasury debt. Government debt is issued. People pay dollars for that debt. So the government gets dollars that they can then spend via the TGA. So this is how deficits are financed. You issue that much in terms of new debt, use the dollars that you raise to then spend on jobs programs, unemployment benefits, whatever it is. But you need the economic balance sheet capacity to be able to absorb a deficit. And that balance sheet capacity can best be think of as GDP. This is gross domestic product, or the total economic output of, in this case, the US economy. Well, GDP during a recession, as if it wasn't bad enough with spending going up and revenue going down, as if that was not bad enough, GDP, which is the denominator for your fiscal deficit as a share of GDP, your denominator here is also falling. So in general, it falls by about 4.5%. Well, that would take our GDP from 30 trillion down to 29 trillion. So now, as a share of GDP, that $4.5 trillion deficit would become a 15.5% deficit as a share of GDP. Again, GDP is the ability for the US economy to absorb all this new debt that is being issued. It is, you can think of in some ways of the demand side in the supply and demand imbalance when it comes to debt. If the supply is skyrocketing because we're running ever larger deficits, right? 4.5 trillion, the deficit just doubled in nominal terms. So we have to issue even more debt. We have to double the amount of debt we're issuing. Well, GDP is the ability for the US economy, the demand side, the ability to absorb all that new debt. And we just established GDP is going down. So it actually is non-linear because both things are happening. The numerator is rising, the fiscal deficit just doubled, but also you have GDP falling, right? Remember, this is a ratio, fiscal deficit divided by GDP. So both of them are going in the wrong direction. And you're now talking about a 15.5% deficit, which is up here, not even reached during 2020. But wait, it gets even worse. So here's the rate of change of debt issuance. In red, and then in white is the annual growth rate of the economy in nominal terms, again, including inflation. What we can see is, again, during a recession, the nominal growth rate plummets kind of by definition. You might have deflation adding to some of that, and you might also have real GDP contracting. That's kind of by definition what a recession is. So nominal GDP is plummeting. Well, at the exact moment that is happening, your debt issuance is growing at above 20%. If we look at the past two recessions at its peak, it was growing, new debt issuance was growing at about 20% year over year. Well, that's at the exact same time that your balance sheet capacity in terms of nominal growth is falling. Anyways, hopefully that concept makes sense. Here is the consequence of that. Here's debt to GDP, and we can see that it declines as the growth rate is higher than the cost on our debt, the interest rate on our debt, as measured here by the 10 year. The opposite is also true. If the cost of our debt is above the nominal growth rate, then we can see debt to GDP goes up. And that is reflected by these red boxes. Well, something you might notice, those red boxes correspond to recessions. Every time there's a recession, the cost of our debt spikes above our nominal growth rate. And you can see here, for example, in 2020, the cost of our debt as measured by the 10 year was 738 basis points higher than the nominal growth rate. And so, by definition, as this happens, debt to GDP goes up. The debt burden gets worse. We know debt to GDP is about 125%. Well, here's, I think, a good chart that represents the already existing inability in terms of capacity to absorb all the debt that we have issued. Debt to GDP has doubled. If we go back here to 2007, debt to GDP has doubled just since 2007 alone. And look at this. So, this is government debt that is held by the Fed as a share of GDP, and it is 15%. If you look at the long run average, it was between 4 and 5%. So, the Fed has stepped in to buy and absorb all this new debt that the market really actually doesn't want. It is reflected, the white line reflects this perfectly. We can see that the market doesn't really want all this new debt. Therefore, the Fed has had to come in and triple the amount of debt that the government debt that the Fed is holding as a share of GDP. That has tripled. Again, long run average between 4 and 5%. This white line represents the ability, that balance sheet capacity, or the demand side of the bond supply and demand. This represents, I think, the demand side, which shows that the market, the free market, does not want all that new debt. And so, in order to keep the wheels on the bus, the Fed has stepped in to an ever increasing degree, printed dollars out of thin air, bank reserves, used those bank reserves to purchase a government debt from the banks. This is QE. And as this is happening, this is reflecting the fact that the market, really, the capacity to absorb all this new debt has already been declining for the past 20 years or so. But wait, it gets even worse. So when you look at the return on each new dollar of debt since 2007, we are issuing, for every $1 of new debt that we are issuing, we're getting 34 cents of GDP. And Bergen Henderson and other academics have studied this and found two things. Number one, as government spending becomes a larger share of the economy, as we've seen, this has doubled. It reduces your capacity in terms of GDP. So you are capping your potential, your gross domestic product potential. You are reducing the amount of GDP that you can get. And this is due to a multitude of factors that they cover in their paper. But the other thing, too, is that as debt to GDP is increasing, as we saw here in blue, now at about 125%, you also get a falling return in terms of the marginal return on each new dollar of debt. So as the debt is increasing and GDP is falling, right, during a recession, if they were to try to keep GDP just flat, not growing and not contracting, if they were just trying to keep GDP flat, they would have to issue $3.7 trillion in new debt, assuming this 34-cent return on each new dollar of debt. But as we just established, the return would actually be going down in this case, because again, as debt to GDP goes up, your return goes down. As government spending as a share of GDP goes up, your capacity for real economic output goes down. So hopefully it's clear that these things start to behave in nonlinear ways. And just to really illustrate it, here in red is debt, GDP divided by gross government debt. And what we can see is that debt has been growing much faster than GDP, which is why this red line is going down. This red line represents the degree to which GDP has outperformed or underperformed the debt. If they are both growing at the same rate, this red line would be perfectly flat. But as we can see, the debt is growing much, much faster than the GDP. Again, 34 cents of return for each new dollar of debt. So these things start to behave in nonlinear ways. But wait, it gets even worse. So here we need to look at bond yields because one of the major drivers of the deficit, fastest growing budget item currently for the US government, is interest. So we need to look at the yield curve. Here in purple is the 30-year, blue is the 10-year, green is the 5-year, red is the 2-year, orange is the 1-year, and light yellow is the 3-month bond yields. Here we're looking at June of 2019 through the end of 2020. This was really the last time we got a concerted rate cutting cycle. And in white, that is that federal funds rate. That is the overnight interest rate that the Fed controls. And what I want to point out is that, again, the repo rate crisis of 2019 was kind of an outlier. But in general, during this rate cutting cycle, especially in February, March, April of 2020, as the white line is being cut, as the federal funds rate is being cut, look at what bond yields did. Bond yields fell. They fell the most at the short end, right? Like the 3-month. You can see the gap between the long-term rates and the short-term rates was growing wider, but it was because the short-term rates were falling at a much quicker pace than the long-term rates. All the rates were falling, but it's just the short-term rates were falling at a faster rate than the long-term rates. This is also true if we go back to 2008. Here we're looking at 2008 rate cutting cycle. And again, you can see a similar dynamic, which is as the federal funds rate is being cut, all rates are declining. It's just that the short-term rates are declining at a much faster rate. Therefore, the gap between the long-term rate and the short-term rate is growing wider. This is what's known as a bull steepener because, again, the bond yield is inverse to the value of the bond. So this is what the value of the bond would look like. People were buying bonds as rates were being cut. This is generally what you see as we just established in 2019-2020 rate cutting cycle. This is 2008. The same story is true, by the way, for .com and 1990 long-term capital management. All you go back and you always see a bull steepener where rates are falling, value of the bond going up. It's just that short-term rates are falling the most at the fastest rate. So therefore, the gap or the steepness of the yield curve is increasing. Well, we are in a rate cutting cycle today, starting in September of last year. And what have we seen? We have seen what's called a bear steepener. So this has really never been seen before in the US. This is where you are cutting that overnight interest rate as seen in white, but yet long-term rates are going up. We established in 2008, in 2019, the Fed's cutting rates, the white line, and rates are falling. They're just falling the fastest at the short end of the yield curve. But that is not what we have seen in this rate cutting cycle. You have to look at it in terms of cycles, rate cycles. We are in a rate cutting cycle since September of last year, and long-term rates, really even at the belly of the curve, have gone up. So this is what's known as a bear steepener. It is bearish for bonds, kind of by definition. Here's what the value of the bond looks like. You can see that since the Fed started to cut rates, you've gotten the opposite reaction of what you would expect to see, which is that bonds did not rally and therefore interest rates come down. In fact, bonds sold off and interest rates went up. So this is, again, never really been seen before, but this indicates that we are in a different regime. This is why I always show this chart is really critical to not just translate just the way it used to be to the way it always will be. We can see the 30-year yield, for example, the day before the Fed started to cut rates was at 396. Well, it is now 100 basis points higher at 496. So we have to look at not the way that things used to always be, but the way they are, what the data is showing today, which is that if we were to cut rates due to a recession, you could very likely continue to see a bear steepener. You could see rates even go higher because, again, the bond market is pretty smart people. This math is not complicated. If I can figure out this math, in just half an hour or so, the bond market surely can. And again, remember the way that $4.5 trillion in terms of deficit is financed is by pushing that much more debt onto a shrinking economy, an economy that is already showing you that it does not want all of that debt. That is what this white line is proving to you. Going back to the past 20 years, the Fed has had to come in to prop up to buy an ever larger share of that debt. So arguably this really already started 20 years ago. But in terms of what interest rates would do, well, they would actually go up. And so your interest expense takes your $4.5 trillion deficit. Now you're talking about a $5 trillion deficit because interest rates are going up. And of course, this becomes nonlinear. So now you're trying to push $5 trillion into a bond market that does not want it, does not have the capacity to absorb it. So rates go even higher, blowing out your interest expense even more. And this is the debt doom loop that people talk about. Well, it appears the data suggests that just looking at where we are already in the current rate cutting cycle, interest rates are not behaving the way they normally do. And we should not expect interest rates to go down, especially at the long end of the yield curve, just because that's how it always used to be. We can see that it is not the way it used to always be. The debt that is held by the Fed as a share of GDP has tripled in the past 20 years. We went from 4 or 5% of GDP to 15% of GDP. The Fed, the buyer of last resort for all that debt, is proving to you that as debt to GDP has doubled over the past 20 years, the capacity for all this debt is already falling. Remember, GDP in a recession falls. And this is your balance sheet capacity. Arguably, the demand has already been falling, which is why the Fed has needed to come in and prop everything up to an ever increasing degree. So this was all prompted by a post that Tyler Neville did on X. I would recommend following him for he's great when it comes to macro. So go follow Tyler Neville. But it made me think of this particular post that I did a long time ago. Basically, I think like a year and a half ago, on why the government cannot afford a recession. It was one of the first posts I ever did that kind of started to really take off. So you can see that there. And hopefully this was helpful. And yeah, hopefully not too terrifying. And I will catch you in the next one.